At the beginning of the year, I said the breakout asset was going to be Bitcoin. I think it looks like it's going to be the resounding inflation hedge asset for the next 50 or 100 years. So that die has been cast. I think you're seeing the last vestiges of people using gold as a rational economic insurance policy, but I think the future is specifically Bitcoin on that dimension. So I guess you could trade that, you could speculate on that.
At the beginning of the year, just before the approvals of several spot Bitcoin exchange-traded funds by the U.S. Securities and Exchange Commission, billionaire venture capitalist Chamath Palihapitiya chose Bitcoin and Bitcoin ETFs as his most anticipated trend of 2024. The venture capitalist also made some important predictions about Bitcoin and Bitcoin ETFs, projecting that 2024 would be the most important year for the leading cryptocurrency since its creation. He predicted that Bitcoin would cross the chasm this year and really see mainstream adoption. Chamath also said he was certain that Bitcoin would become a part of the traditional financial lexicon by the end of 2024. But Chamath's most important prediction for Bitcoin is his prediction of an impending massive bull run ahead for the cryptocurrency. During one of the earlier episodes of the All In podcast, the billionaire pointed out that in previous cycles, Bitcoin's price remained in the same range within 3 to 6 months after the halving events. However, after the 6th month, things get really heated up and prices skyrocket. He is predicting a similar order of events in 2024 and 2025, both in terms of prices and increased adoption. Chamath estimates that Bitcoin could reach more than $500,000 per coin by October 2025, which marks exactly 18 months post-halving. He reiterates these predictions in the latest episode of the podcast, with 2 others of the besties, entrepreneur and angel investor, David Friedberg and David Sachs, co-founder and general partner at Craft Ventures, discussing how the gloomy fiscal situation in the US and across the globe is driving investors towards safe haven assets like Bitcoin and gold. As we bring you clips from the discussion, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks, and enjoy the video.
There's another couple of nuances here that I think are important. The US dollar complex is thriving, which means like the US dollar is strong. Back-end yields are rising. And then another thing that I look at is this thing called put-call skew. So basically, like on balance, how are people hedging in the short term? And in the bond market, they own a lot more puts than they do calls. I think that this is the entire financial infrastructure of the world repositioning itself from what was a toss-up election to a Trump win. And when you look at why, it's because when you forget the candidates themselves for a second, but if you think about the actual policies and where the spending will occur, I think that there has been a very clear decision that the Trump economic plan will drive better growth than the Harris plan. And if you think that there is more growth coming, typically what will come with that is a little bit more inflation. The risk premium that you're going to need in a high growth environment is higher. What is risk premium? That is, how much do I want to invest for a risky asset versus a safe asset? And so all of these things are coalescing. So I think that the short-term takeaway that I have just looking at all of this data is that in the economic distribution of outcomes, this is now tilted overwhelmingly to a Trump win. And this is not an emotional statement or what I want to happen, but this is just an observation of how tens of trillions of dollars of self-interested financial actors have now repositioned their risk. And if Trump wins, which it looks like he's increasingly going to do, and if he wins by the margins that it looks like it's going to do, you're going to see a lot of these things exacerbate. Gold's going to go up more, probably. Bitcoin will probably go up. The short-term economic upside for the economy will probably get reflected in higher equity prices, but it'll also push out long-term rates. The inflation picture becomes a little bit murkier. But I think that that's what's happening. I think that the financial markets are pricing in a Trump win.
Sorry, just to understand better, why does gold go up in a Trump win?
I think in the short term, what happens is that you see more economic growth, but in the medium term, inflation goes up, and so you want to hedge.
Right.
So it's more about a durational balance of assets. So in the short term, you'll be long the things that will generate earnings, but in the medium to long term, you want to hedge yourself. So Bitcoin and gold, I think, will trade that way.
As you heard right there, the key line that Paul Tudor Jones said was all roads lead to inflation. I mean, that's what's basically happening right now, is that the market is afraid that inflation is not whipped and is going to resurface, and the Fed may have to pivot from the pivot and raise interest rates. That's why he doesn't want to own any treasuries. Separately, another financial legend, Stan Druckenmiller, gave an interview where he has something like a 20% short position, meaning 20% of his holdings are short U.S. treasuries right now. So he's betting that there are long-term inflation pressures and that rates are going to have to rise. And you're seeing, again, that since the Fed cut rates on September 18th by 50 basis points, that the 10-year T-bills yield has risen by 60 basis points. So I think my interpretation is that this is less about the election and more about the markets not liking the Fed's rate cut on September 18th. I think that in hindsight, it was too big.
Sachs believes the Federal Reserve's 50 basis rate reduction in September was a subtle admission that all is not well with the U.S. economy, despite Fed Chair Jerome Powell's remarks that the economy has turned the corner. Shortly after the Fed's rate cut announcement, Sachs observed that the central bank has initiated a rate-cutting cycle, with a 50 basis point cut only thrice in history. During the dot-com crisis in 2001, the Great Financial Crisis in 2007, and the COVID-19 pandemic in 2020. These were all during severe situations that were followed by severe economic declines. He added that the Fed's decision to start with a 50 basis point cut, despite the official assurance that all is well with the economy, signals that serious problems lie ahead for the U.S. economy. During the episode, Chamath billionaire Sachs noted that the Fed was supposed to tiptoe into a rate-cutting cycle by starting with a 0.25% cut, like the market expected. But they couldn't, because Powell and other FOMC officials are already in panic mode and are only trying to maintain a sense of calm and normalcy so the entire economy does not go up in flames. Sachs and Friedberg believe the recent performance of assets like gold and Bitcoin proves these earlier assumptions and signals what lies ahead for the U.S. and global economy in 2025. Here are more clips from the video.
So again, the market is concerned that inflation is not whipped, that the Fed may have been overly precipitous in how it cut rates. And then the other thing is they just do not like the long-term fiscal picture of the U.S. One other chart we should bring up is interest on the national debt. What you can see here is that it has gone absolutely parabolic in the last couple of years. Our interest on the debt, something like 1.3, 1.4 trillion a year.
1.35 trillion run rate. Yep.
Yeah.
$3,500 per American.
And it's something like 20 to 25% of federal revenue now is going to debt service. And this continues to increase. Now, I think there was an expectation that we'd be able to get this line to go back down once we had rate cuts, right? Because if inflation's licked and the Fed can lower interest rates again, and we can get back to a 2% 10-year bond, which is where we were a few years ago, then all of a sudden that national debt service becomes a little bit more reasonable, right? I mean, you could service that debt at half the cost. But now it looks like that may not happen. So just to wrap this up, I just think that the market doesn't like these fundamentals of the U.S. fiscal picture. You've got rapidly increasing debt service costs. You've got an inflation picture that is murky and may not be going away. And the bond markets are starting to price in higher interest rates for longer. And this is why Paul Tudor Jones is saying all roads lead to inflation. And this is why Druckenmiller is shorting U.S. treasuries.
So just to give you guys a sense, total U.S. household, corporate, and government debt, which includes state and local and federal. So household debt in the U.S. is about 18 trillion. Corporate debt's about 11 trillion. State and local government debt's 3 trillion. Obviously, the federal debt, 36 trillion. That adds up to a whopping $68 trillion of total debt across the U.S. which if you assume a 6% average interest rate, you got corporate debt and household debt, so it's a little more risky, so it carries a higher rate. That means we're spending about $4 trillion a year of an economy that's only $29 trillion a year to service the debt, just to pay the interest on the debt. So 15% of every dollar that trades hands is going towards interest payments on existing leverage, on existing debt. It's a highly leveraged system. And if you look around the world, this problem is not just a US challenge. Global leverage is a problem that's now becoming a crisis for countries everywhere. So this is becoming kind of a global leverage problem, which might explain the flight to safety in assets like gold and Bitcoin, and is going to present a lot of real struggles for every global economy. Now, the question is, does the US dollar maintain its reserve status? Because ultimately, I think it is inevitable that the Federal Reserve in the United States is going to need to buy the debt. They're going to need to monetize the debt, which means printing money. There is no one else to buy the debt. So pull up the China chart, Nick. China's historically been the biggest buyer and owner of US Treasuries, but here's what's happened in the last couple of years. It peaked at about $1.3 trillion about 10 years ago. And then recently, particularly starting around COVID, they began selling down and have been selling down at an accelerated pace. Today, China is back to the level they were at nearly 15 years ago in terms of their treasury holdings. And they have publicly declared that they are selling off US Treasuries and buying gold instead. So the biggest buyer of US Treasuries has kind of left the market or is leaving the market. Who does that leave? Well, at the end of the day, the Federal Reserve has been the kind of buyer of last resort. And if they end up buying treasuries, that's where we have a problem with too many dollars and inflation kicking up. And so it feels like a lot of the trades in assets are what's going to benefit from the inflation. And it's going to be gold. It's going to be Bitcoin.
In related news, the International Monetary Fund has issued a dire warning about the global public debt situation, which it predicts will rise above $100 trillion by the end of the year, with the US and China accounting for a significant share of rising public debt levels. In a report released on Wednesday, the IMF warned that global public debt will reach 100% of world GDP by the end of the decade, a troubling situation it says would have dire consequences. Public debt may be worse than it looks, said Vitor Gaspar, the IMF's Director of Fiscal Affairs. He added that governments' debt calculations suffer from an optimism bias and are prone to underestimation. Wednesday's report noted that governments are facing a fiscal policy trilemma. Most governments are spending more to ensure security and growth, and also facing resistance toward higher taxation while public debt levels become less sustainable. The report found that countries in sub-Saharan Africa are most under pressure between the need to spend to alleviate poverty while struggling with lower tax capabilities and worse finance conditions. The report concluded that unsustainable debt levels place the global financial markets at risk of a sudden sell-off if the poor fiscal situation continues to persist. This proves that the demand for safe haven assets like gold and Bitcoin will increase significantly as the situation worsens in coming months and years, putting further upward pressure on prices. Please share your thoughts on the IMF's report and the Bestie's predictions for the global economy and safe haven assets like gold and Bitcoin in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.